Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust or other ways, such as 1031 exchanges, are amazing ways to exit highly appreciated businesses, real estate, cryptocurrencies. You can defer millions of dollars of capital gains tax, and you can create and preserve more wealth or help your clients, friends, and family do the same. For those who don't know me, my name is Brett Swarts. I'm the host of the Capital Gains Tax Solutions podcast, also the founder of Capital Gains Tax Solutions. In each episode, we're joined by some of the best business, real estate, financial, and leadership minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. By the way, we are also streaming on Expert CRE Secrets as well for those who are checking us out there on YouTube. Hey, I'm excited about our next guest. He's out of the great country of London, England, and he's in London, the city, and he is going to be talking to us about how to buy a business using other people's money. Please welcome to the show with me, Jonathan J. Jonathan, how you doing?
I'm great. Thank you for having me.
Excellent. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, sure. So I've never actually worked for anyone else. I've always done my own thing. I'm a university dropout at age 19, started my own business, and it took me about 10 years to find my feet. I didn't have anyone guiding me. I was sort of making it up as I went along. And I had a publishing business, a magazine publishing business. And I remember very clearly the day that someone came to me and they said that they wanted to buy my business. And I was quite surprised because the business didn't make very much money. I seemed to work 7 days a week, but it still didn't make very much money. But I made more money the day I sold the business than I had made in the previous 2.5 years that I'd been running the business, turning up to the office every day. So that was a bit of an eye opener as to what can happen when you sell a business. And of course, you're very aware of the tax breaks that people get when they sell businesses. And then I started a business from scratch, another startup, but this time it grew very, very quickly, very, very rapidly. We did £1 million, which is at that point was about $1.6 million in the first year of trading. This was 20 years ago, when $1 million actually meant something. And that business grew very rapidly. And then a few years later, we bought out our main competitor. And at this point, I learned the benefit of growing a business via acquisition. And I bought out my main competitor, which was a multi-million-dollar revenue business, put that business together with my business, created a larger business, and then I sold that to private equity in 2007 in what was a retirement deal, a life-changing deal. And then over the years, I've bought and sold various businesses. During the pandemic, I bought 48 businesses, which was really going. Sometimes people ask me my advice about buying 48 businesses during a pandemic, and my advice is don't buy 48 businesses during a pandemic. I actually ended up in hospital. The stress was considerable. And not to be recommended at all. And for the last 6 or 7 years, I've been teaching other people how to buy a business as well.
Jonathan J, amazing background and story, and I know we're gonna dive into some great wisdom today on about how to buy a business using other people's money. But if you want to get to with Jonathan J right now, you can go to just YouTube and search Jonathan J. That's Jonathan J. He's got about 15,000 subscribers, and he's putting out some amazing content. So check that out at Jonathan J on YouTube. But Jonathan, let's dive right into the topic at hand, which is the number one secret to buying a business using other people's money. So, Jonathan, what is that number one secret to buying a
Sure.
business using other people's money?
So everyone thinks that when you buy a business, you go to the bank, you find out how much money you can borrow, you give your house, the property that you live in as security, and then you go and give all that money to the owner of the business. They hand you the keys, wish you luck, and that's how a business purchase is done. Well, it can be done that way, but I think it's a terrible way of buying a business because there's just so much risk. You're borrowing all this money with effectively a personal guarantee, a lien over your real estate. And as a result, if something goes wrong with the business, you are still left with the loan. And for me, that's way too high a risk. So what I always say to people is when you're starting out, when you're new to the world of business buying, you need to de-risk the acquisition. And the way we de-risk it is to partially not use our own money, to get our corporate structure right. That's going to be different around the world in different countries. But the key thing is we don't want to spend our life savings. We don't want to borrow using our property, our real estate as security. And that means that you've got a far lower risk transaction. So what we do is we look at different ways of financing the acquisition, depending upon the type of business it is, whether it sells to businesses, whether it sells to consumers. And interestingly, larger businesses are easier to finance than smaller businesses. Now, why do I say that's interesting? I say it's interesting because usually when people think about buying their first business, they go quite small. They go for a business that has annual revenues of a few $100,000. It's kind of in their comfort zone. They can get their head around that number because it's the same value as their real estate. So I always say go bigger. Go for the businesses that have annual revenues of millions of dollars because those are far easier businesses to finance. And we can finance using asset finance. If the business has fixed assets, so plant, equipment, machinery, we can use invoice finance. Sometimes we can use cash flow finance, and we can combine this with vendor finance, where we pay the owner of the business over a period of time. And when we put these pieces together, a little bit like a jigsaw, we start to see the big picture, and the big picture says you've got 100% financing to buy this business. Now, can we do this with absolutely every single business that we come across? No, we can't. We have to pick and choose. But if you want to buy a business without using any of your own money and use other people's money, then you have to look a little bit harder. But there are plenty of deals out there. And I've got people all around the world buying businesses in this way.
Excellent. Okay, so it sounds like the number one secret is to first of all take the bigger approach of de-risking the acquisition, and that
Yes.
goes through corporate structure and making sure that's correct, but also not putting up your life savings and/or leveraging it against your personal assets or something that can really hurt you, personally. As well, think bigger, right? Instead of buying something small, which is more difficult to finance and it probably maybe hasn't, it's not as healthy or hasn't scaled the way it should be. Buy something that's already scaled that has bigger revenues that a bank can even give you a better LTV on. Is that a fair summary?
Yeah, absolutely. See, small businesses are very fragile. I was talking to one of my clients just the other day about an accountancy business that they were looking to buy in Canada, and they told me that there were 4 members of staff in this business, 4 team members, and I said, "So tell me about these people." He said, "Well, there's the owner." And, right, okay. There's the owner's wife. There's the owner's son, and one other person. So you buy this accountancy practice and you immediately take out 3 people. What is left? There is no business left. Well, you buy a business with 50 members of staff and a handful leave when you take over, which is kind of normal. You always get some sort of attrition, but you've still got a strong, stable business. So that size gives you stability, and lenders like stability.
It makes perfect sense, right? Especially if it's a family business. I mean, to think about that, if the owner is the CPA, his wife is doing some of the work too, and the son is maybe a CPA too, or whatever, right? That you right there, you walk out, and then that's 75% of the expertise, especially for something that's so service oriented like a CPA business. On the other side, yeah, if you have 50 employees, there's going to be maybe some opportunities to be more efficient, but at least there's a lot of people there. In other words, you're kind of like diversifying
Yes.
the business to continue to run the ship that's been going forward. Is that a fair summary?
Yeah, absolutely. The diversification is very important. I think a mistake that people often make when they see things like how to buy a business using other people's money, how to buy a business no money down, they think that that is going to be a rubbish business, and the only reason you can buy it, no money down, putting no money on the table at closing, is because it is a rubbish business. Now, there are plenty of businesses that are not good businesses, but you should be avoiding those. The sort of business that you're looking for is a business that is solid and profitable. Because if the business is solid and profitable and it continues to be solid and profitable, even when the owner is removed from the equation, then that is a business that will put money into your pocket every single day, week, and month and year. Where some people advocate you buy a distressed business, a business that's on its knees, it's seen better times, it's maybe even losing money, and you buy it for $1 and you turn it around and you're a hero and you ride off into the sunset with this magnificent turnaround of the business, and everyone says how clever you are. Now that might play to your ego, but it's not good business sense. I've done turnarounds and I've been very successful at them, and I've done turnarounds and I've failed. And I've failed with lots of experience of doing this, and I've still failed. So if someone's doing this for the first time, the odds are not good.
You can find more at YouTube channel by searching Jonathan J. if you want to learn how to buy a business using other people's money and so much more. So I think we've covered a couple of the additional secrets. Let's see if I got them here. So it sounds like besides de-risking the acquisition, right, and buying larger businesses, another mistake that people make is thinking that just because you're getting favorable financing or favorable low down payment or no money in, that somehow the business has intrinsic value that's maybe not as high, or there's a lot of risk there, or something that's you're missing. It's probably not a good business to buy anyways, right? No one would ever do that deal. Number two, that if you're buying something, if you're going to buy something, make sure on the intrinsic value of the business. Is it durable cash flow based upon the fundamentals of the business, regardless of how you make the terms in the deal, whether it's with low down payment? I think that maybe it's kind of one and the same, but is that a fair summary, not to make that mistake that you're letting the terms or you're letting outside influence what's really happening with the business?
Yeah, I think it's important to realize that you can have a distressed owner, an owner who wants to get out, but the business itself isn't distressed. So it can be a good, solid business, but you've got an owner who's very motivated to sell for personal reasons, not for business reasons, for personal reasons. So these days, the number one reason is retirement. And we are in an aging population. There are more owners at retirement age now, or coming up to retirement age, than ever before. There are a lot of people retiring earlier than before. They've been beaten around the head by the pandemic, and now there's this worldwide recessionary times that we find ourselves in, and they don't want to do it all over again. So people are retiring a little bit earlier. That means there's a lot of businesses coming onto the market, and that's great for someone wanting to buy a business because it's a buyer's market. There's more choice. Now, when you've got more choice, that usually suppresses price. It means that you can negotiate better terms, but these are still good, solid businesses. It just means that the overall economic environment and the motivation of the seller has allowed you to take advantage of that situation and being able to negotiate a better price and better terms. And I'd actually say that the terms are more important than the price in some cases. Everyone wants the lowest price, but
So
you can have a good price.
let's get super practical, and that's all.
Yeah.
It's all makes a ton of sense there. I love that. That even though it's a distressed seller, doesn't mean it's a distressed business, right? And vice versa. Just because it looks so attractive, you got to be careful to find out really what's going on with the business itself. Buy the business. Don't necessarily buy the other person's personal problems or not, or the reasons they're selling. They could be retirement. It could not even be challenged. They're just ready to retire and move on. So great. Now let's dive into the practical part of it. So how do you actually buy a business using other people's money? What would you say the secret to doing that is, or the people that are most successful? How are they unlocking the seller to finance them? A and B. What are some creative ways to get that to happen with banks and with seller financing?
Yeah, sure. So I have some people come on my courses, know exactly what sort of business they want to buy. They have a dental practice, they want to buy another dental practice. And then I have a group of people, a percentage of people, maybe 30, 40%, who don't know what type of business they want to buy. And I would help them and advise them on, you stick with something that you know. And then a lot of people say, well, I don't know anything. So let me tell you what I do now. I'm very directional. I say, if you don't know what type of business to buy, I'm going to tell you exactly what type of business to buy that is the easiest to finance and has the best chance of success. Okay. So these are the rules generally. You want a business that's doing at least $2 million of annual revenue. That's the first thing. The second is you want a business that sells to other businesses. Because if a business sells to other businesses, that unlocks types of finance that you can't get if a business sells to consumers. Number three, you want a business with assets, fixed assets. We're talking equipment, plant, machinery, and the bigger the better. I've got a client who's looking at a concrete manufacturing company, and yeah, that has big equipment in there. So we're not talking about assets like desks and secondhand PCs. We're looking at the big assets. Then ideally, we want to also tick the next box, which is the business is successful and profitable. That always has to be the case, but it is accumulated cash in the bank. And if the business has accumulated cash in the bank, we can actually use that cash as part of the way we compensate the seller for the business. And just to go back one thought, with those assets in the business, we can finance those assets as well. So what we're looking for is a business that's successful and profitable with cash in the bank, sells to other businesses, at least $2 million of revenue, and has these fixed assets. And plus, if we can get this one in as well, it has recurring revenue streams in the term of long-term contracts. So it has a 3-year contract with that local authority. It has a 5-year contract with that company. So it has revenue locked in for years to come.
Got it. Okay, so that's makes perfect sense. And then that's super clear. That's like the framework. Now we take that obviously to a bank, right? That's other people's money. Or we say, Mr. Seller, would you finance us and we'll pay you back over time and perhaps defer some capital gains tax so they don't have to pay as much tax. Walk us through that strategy.
Yeah, sure. So depending on what the business has is how we construct the deal. And the deal is a construction where we're going to be taking lots of these elements, maybe 2, 3, 4, maybe all of these elements in some way. And again, just like the pieces of a jigsaw puzzle, we're going to fit them together to create that 100% financing piece. That's what we're going to do. So the percentages depend upon what we've got. So if we've got $1 million of cash in the bank that is surplus to the working capital requirements of the business, well, there are ways of using that $1 million as part of the payment for the business that's more tax effective. And I can only speak for the UK's tax system, but in the UK, that's a more tax effective way of the seller getting the money out of the company rather than taking it out as income. That's number one. We know that when we look at the assets, we can maybe borrow 80% of the asset value. When we look at the invoices, if the invoices obviously have to be to other companies, to other businesses, and if they're good quality clients who pay their bills, then you can get 90% of that value. So what I'm doing, partly in my head and maybe partly on paper if it gets a little complex, is writing down what I can get for all the different parts of the business. And the shortfall is made up with the vendor financing, where they effectively lend you the money over time. And if there's still a gap in expectations between what we can raise and what they really want, we can do something called an earn-out, where if the business is more successful, then the seller gets more. If the business isn't as successful as everyone hoped, they get less.
Okay, so it's getting more granular into all of the ways in which we could ask someone to finance bank, seller, equipment, earn out, cash reserves, and then try to create a solution for the seller. It could
Exactly.
be, if they can delay some tax because they're not getting it all up front. Again, I don't know how the UK works for here in the US. That's a common way for people to delay taxes by not actually receiving the money right away or all at once. Part of what we do here is with the Deferred Sales Trust, it's exactly that. By the way, whether you live in the US or not, if you have an asset that's subject to capital gains tax, you're selling in the US, you can delay it. And by delaying it, you can grow that wealth and let it compound and live off the interest and different things like that, and just pay tax slowly over time. I'm curious, does the UK have anything like that, like a 1031 exchange? Have you heard of that before, or some kind of exit where you can defer capital gains tax but still not have to just finance the buyer? Is there anything like that in the UK?
Yeah, it's actually usually it's the opposite, where the seller of the business has to pay the tax at the point of sale or in the tax year of sale, even if they haven't received it yet. We have to pay the tax in advance of receiving the cash. So that's really tough. You have a better system than we do.
Yikes, that sounds tough. So before they even sell, or the government says we want our part already. It's almost like it's
Yeah.
the debt. It's like, hey, we're the lender, we're going to get paid off, or the capital gains tax. And I'm curious, what are the rates there? Like, if you started a business at zero and you sell it for $10 million, how much would a seller potentially have to
Yeah.
pay
So so
capital
the
gains tax?
so the first so the first $1 million is 10%,
Okay.
and then thereafter it's 20%.
Okay. Well, Taxifornia, it's like 37%. You got 20% federal, 13.3 state of California. It's actually income tax, but it's the way it's calculated through the capital gain. And then you have 3.8. It's like the Medicare tax. So it ends up being like 37. But then this thing called depreciation recapture, where if you've had equipment or if you had other, if it's real estate, you depreciate it, that can push it to 40 or 50%. And so it's people just, they just go, forget it, I'm not selling. Right. Or I'll just pass it to my kids and get a stepped up basis. In the UK, is there a thing called a stepped up basis where if that business is worth 10 million, it passes to a child or children? Is the basis stepped up at the time of death of the assessed value, or is it still the original, zero or a million?
That's not my tax is not my knowledge base. I,
Okay.
I I have people I go to for that. So we certainly don't call it that. It doesn't sound familiar, but there may be something similar.
So it's probably not, because to me that's one of the best things that we have in the U.S. system that's still alive. Although last time they tried to, there are those in the political arena who would prefer to take that out. It didn't pass, but it would have been monumental. But right now, it's still there. By the way, if anyone's curious about anything I'm talking about, especially if you're in the U.S. or you have something that's subject to U.S. capital gains tax, you can go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com, where we can show you how to eliminate the need for 1031 exchange, how to defer capital gains tax, how to eliminate estate tax. Regardless if you're a U.S. citizen, it just has to be subject to U.S. capital gains tax, which a little fun fact here, by the way, if you're curious, let's imagine you live in the UK and you built a $100 million business in the US. That is subject to estate tax upon death if you haven't done any estate planning. And the exemption is like $68,000. Now, if you're a U.S. citizen, you got about a 24 million married, 12 million single. But whatever you're looking at, you always want to make sure you have a team in place, you have a strategy in place, and you have a plan to execute on that. Because otherwise, you're paying 40% death tax if you're not a U.S. citizen, and then up to 25 to 50% capital gains tax, regardless if you're a citizen or not, on the sale of highly appreciated assets. Go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. That being said, Mr. Jonathan J., are you ready for the lightning round?
I don't know what the lightning round is, but let's do it.
That's the best way to not know about it, is to jump right in. All right, Mr. Jonathan J., if you could go back to your 25-year-old self, what's the one golden nugget you make sure to tell yourself to do?
Always save money and build up a reserve of cash that you don't touch, because you never know when you might need it.
Excellent. Question number 2. What's the one book you've recommended the most in the past year,
Oh,
or gifted to someone in the past year?
yeah, I can tell you exactly what that is. It's called Insane Productivity for Lazy People. And I'm not entirely sure which part of that title was the most attractive to me, the insane bit or the lazy bit. But I've read it twice. I started reading it the second time after I finished the final page the first time I read it through, and I've been recommending it to all of my groups. It's a great book. It's a short book, but it's a great book all about productivity, because for me this year, my focus is to be way more productive than I've ever been.
Excellent. Question number 3. What's the number one leadership quote or theme that you strive to live by?
Leadership quote or theme. Well, I'm not sure if this is exactly answering your question, but the one quote from Brian Tracy, the author and speaker, that I've always remembered and I quote to people all the time, which is, becoming a millionaire is not about the money. It's about the person that you need to become to be someone who is a millionaire. And I think it's very fair to say that people change dramatically on that journey, and you need to be a different person to be a millionaire than you are if you're currently on a fixed salary, for example.
Great wisdom by Brian Tracy. Love Brian Tracy. What's the one big domino, Jonathan J., that if you could knock over for your business in the next 90 days, that would make the biggest impact for your company's future?
It is being able to attract strangers from the internet and turn them into valued clients who know, like, and trust you. And if you have that marketing process and it's replicable, and you do it every week, every month, and it keeps on going and going and going, then you have a business that will just keep on growing.
Fantastic. I love that. What are you most curious about right now?
My health. I think I mentioned earlier that I hospitalized myself as a result of the stress of integrating 48 businesses in a very, very short period of time. And I am now doing. I'm 51 years old. I'm doing more exercise than I've ever done in my life. I'm sleeping better. I'm eating better. I've cut out all the bad food from my diet. I've lost a lot of weight since January. And I'm curious about transforming my health.
Okay, I like that. Last question. After all your success, helping all the people you've helped to buy businesses using other people's money and build wealth for their families, and perhaps even retire better, right, through better terms with how they structure deals. How do you stay centered? What's the number one habit you're practicing to stay centered in your values and stay charged up and encouraged to charge forward to reach new heights?
Yeah, well, I can tell you exactly what keeps me centered and grounded. I have a 7-year-old daughter, and whatever you do in your business life, like tonight when I put my daughter to bed and we're going up the stairs and she's on my back and she's hanging onto my back and I'm pretending to be a steam train. That keeps you. Children keep you centered.
Absolutely. Hey, Jonathan J., I want to thank you for being on the show. I want to thank you for sharing your expertise, your gifts of communication, your gift of business acumen, and looking out for ways to be creative, your creative mind with us. I so appreciate someone from the UK. I don't know what hour it is there to be spending some time with me out here in the US. I want to encourage you to keep helping more people, keep creating content, and keep changing people's lives. If people want to get in touch with you, can you remind them one last time what's the best place for them to find you?
Find me on YouTube, Jonathan J on YouTube. There's about 200 videos all about buying a business, lots of interviews with people who've done it already. So watch the interviews and be inspired.
Amazing. And thank you, John, for being on the show. I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. We're also streaming on Expert CRE Secrets podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust, or getting with someone like a Jonathan J. so you can buy a business, on great terms, right? It can be some of the best ways to create and preserve more wealth. We want to encourage you to go to capitalgainstaxsolutions.com, download our free ebook if you want to get started on your exit plan for your business, real estate, cryptocurrency, primary home. Also, check out the new book that's coming out soon with Kevin Harrington from Shark Tank. It's actually going to be called Building a Capital Gains Tax Exit Plan. This was just the potential blueprint here. But if you're seeing that, that's coming out in about 21 days. Pretty cool. We hope you can pick up a copy of that. And other than that, we appreciate everyone listening, and we'll talk to you again real soon.